Imagine spending like $6 billion to buy your way to the top of a massive global industry, only to wake up one morning and realize you totally forgot to build a cash register.
Right. It sounds like a bad joke.
It really does.
Yeah.
But that is the exact scenario currently unfolding right now in the world of professional sports. Welcome to today's deep dive. We are looking at a comprehensive, globally sourced research analysis of LIV Golf.
And specifically, we're examining the sheer chaos happening on the ground as of mid-April 2026.
Yeah, and the scope of the material we are diving into today is just massive.
It is. We've synthesized a stack of highly credible, up-to-the-minute sources to really understand the situation. We're talking about deep, verified reporting from the Financial Times, the Wall Street Journal, Sports Business Journal, Fox Sports, Front Office Sports, and a very detailed geopolitical strategy report.
So our mission today is explicitly clear for you listening. We are going to cut straight through all the social media noise.
There is so much noise.
Exactly. We are ignoring the public relations spin, and we're going to look purely at the verified data, the financials, and the rapidly shifting geopolitical landscape. We want to answer one massive question. Is this $6 billion disruptor of the golf world actually collapsing in real time?
But before we get into the numbers, it's really important to lay out our parameters here.
Right.
The sources we're analyzing contain extensive discussions about geopolitical conflicts, human rights criticisms, and, accusations of sports washing.
Yeah, that term comes up a lot.
It does. And we want to be absolutely clear to you, the listener, that we are not taking any political sides here. Our goal is strictly to impartially analyze how these international realities are directly impacting LIV Golf's bottom line.
And its strategic future, right. Because we really need to start by looking at LIV's core product. The sources show a league that has fundamentally altered its own DNA recently.
Yeah, they really have.
Like if we look at the timeline, they launched in 2022, right? And they used this blueprint from 2020 called the Premier Golf League concept.
Right, the PGL.
Exactly. And it was pitched as this radical revolution. 54 holes, shotgun starts, so everyone finishes at the exact same time, 12 teams, and crucially, no cuts.
Meaning every single player gets paid no matter how badly they play.
Right. And then we had that shocking framework agreement with the PGA Tour in 2023, which kind of just stalled out.
It really went nowhere.
Yeah, but looking at the data for 2026, LIV has made a massive structural pivot. What exactly changed this year?
Well, the changes are foundational. In 2026, they expanded the field to 57 players, and they introduced a relegation system.
Wait, relegation? Like in European soccer?
Exactly like that, meaning the bottom 20% of the field actually loses their spot on the tour. But most importantly, they abandoned their namesake.
The 54 holes.
Yes. The Roman numeral LIV literally stands for 54, but they've completely moved back to the traditional 72 holes.
That is wild. And the sources also detail how hard they are leaning into tech to chase this, younger demographic. They introduced this AI agent called Chip, powered by Salesforce to predict shots.
Yeah, and that any shot, any time at feature for the fans.
Right. And to be fair to them, they are getting massive live crowds in secondary golf markets. The data shows 115,000 fans showing up in Adelaide, Australia.
Which is a huge number.
And over 100,000 in South Africa.
Yeah.
But, and this is a big but,
yeah,
they still aren't getting any real traction with American audience.
No, they aren't. And that highlights a fascinating disconnect between the live event experience and the broadcast reality.
How so?
Well, EV successfully identified that regions outside the U.S., like Australia, were just starved for premier live golf.
Yeah.
But the mechanism of a sports league is that it simply cannot survive on ticket sales alone.
Especially not with the kind of overhead LIV is carrying. I'm getting stuck on this 2026 format change, though. They branded themselves as the ultimate disruptors, and now they are suddenly playing 72 holes and relegating players just like a traditional tour.
Yeah, it's a huge step back.
It's like a disruptive tech startup pitching this radical new app and then suddenly pivoting back to selling desktop software just because nobody bought the app. If they are abandoning their disruptive identity to play by the establishment's rules, what was the point of the disruption in the first place? Was this actually about innovation?
No, not at all. It wasn't about innovation. It was a capitulation for legitimacy.
Okay, unpack that for me.
To understand why, you have to look at the official World Golf Ranking, or the OWGR. The whole golf establishment measures historical greatness through these rankings.
Right.
And Levy's original 54-hole, no-cut format was structurally incompatible with the OWGR's mathematical models. Because Levy players weren't earning these points, they were just plummeting down the world rankings.
And if you plummet down the rankings, you lose access to the major championships, right? Like the Masters, the U.S. Open.
Exactly. And the majors are the absolute lifeblood of a golfer's legacy. LIV executives realized that if their stars couldn't qualify for the majors, the league would permanently be viewed as just a lucrative exhibition.
Rather than a real competitive sports league.
Right. They changed to 72 holes because the broader golf ecosystem basically forced them to in a desperate bid to get those ranking points.
Which brings us to the financial reality. If they are capitulating on their format just to be taken seriously, what exactly are they still spending so much money on? Because the numbers in these sources are absolutely staggering.
They really are.
I mean, the Saudi Public Investment Fund, the PIF, they've invested $5.3 billion so far. And they are projected to hit $6 billion by the end of 2026.
And that capital is vanishing rapidly because the operational costs are just astronomical. Front Office Sports reports LIV has an operational burn rate of $100 million per month.
$100 million a month.
A month. And over the lifespan of the league, they will have paid out roughly $1.9 billion just in player prize money and upfront bonuses.
Wow.
Yeah, just to put 2026 in perspective, they raised the individual event purses to $32.3 million.
But what is coming back in? Like, if you look at the UK-based arm, LIV Golf Ltd., they reported their 2024 financials, and they lost $461.8 million against only $64.9 million in revenue.
Yeah, it's a total bloodbath.
It is. Yet simultaneously, LIV executives hired Citigroup to sell team ownership stakes. And they're claiming a target valuation of $1 billion per franchise.
Right.
Meanwhile, a nice CEO, Scott O'Neill, openly admits the league is still 5 to 10 years away from profitability. Help me square this circle. How does a team get valued at $1 billion while the league is bleeding $100 million a month?
Well, to understand that contradiction, we really have to look at how sports franchise valuations actually work. The traditional sports model, like an NFL or an NBA team, relies on a closed ecosystem with massive, guaranteed media rights revenue.
Right, like the huge TV deals.
Exactly. And that revenue is equally shared among the owners. That baseline revenue guarantees profitability, which then drives the franchise valuation. LIV is trying to reverse engineer that reality.
Oh, I see.
Yeah, they're trying to sell the idea of a franchise before the foundational media revenue even exists.
So it's like trying to sell an empty shopping mall for top dollar and basing the price entirely on how famous your security guards are.
That is a perfect analogy.
Because the value of the mall isn't the guards, it's the foot traffic and the store rent.
Yeah.
LIV has all these incredibly famous golfers, but they don't have the foot traffic or the rent coming in.
Exactly. And the geopolitical strategy report we analyzed actually built a mathematical model explaining this exact dynamic.
Oh, really? What did it say?
They modeled the probability of LIV's continuation as a function of the league's strategic utility to Saudi Arabia relative to its operational deficit.
Okay, in English, what does that mean?
In simple terms, as long as the Saudi state felt LIV was providing immense cultural or geopolitical value, they were perfectly willing to cover that $100 million monthly deficit.
Oh, okay.
But the moment you asked an independent private equity firm to buy a franchise, they do not care about strategic utility, they only care about commercial math. And the commercial math right now is entirely toxic.
And the math isn't just toxic for outside investors. I mean, the players seem to be doing the math, too. Let's talk about the talent migration.
Yeah, this is a huge shift.
Because back in late 2023, LIV hit its high watermark. They signed Jon Rahm for a reported $500 million. I mean, at the time, it felt like an existential threat to the PGA Tour.
It definitely did.
But if you look at the 2026 sources, the migration is completely reversed.
Right. The initial draw of that generational wealth is really losing its shine. Brooks Koepka, who is a 5-time major champion, he broke his contract a year early just to leave LIV. And Patrick Reed left to join the DP World Tour, which is the primary European golf circuit. It's a step below the PGA Tour, but it's fully recognized by the establishment.
Right.
And Bryson DeChambeau, who has arguably been LIV's most successful player on the course, is reportedly refusing to sign a contract extension.
See, I need to understand the mechanics behind this exodus, because the sources talk about a massive counterattack by the PGA Tour involving the Strategic Sports Group, or SSG, what exactly did the PGA Tour do to flip the momentum so dramatically?
They completely changed the financial psychology of professional golf. In 2024, the PGA Tour took a $3 billion investment from SSG, which is a consortium of heavy-hitting American sports owners.
Okay.
And they used that money to form a new for-profit entity called PGA Tour Enterprises. The masterstroke here was that they offered $1.5 billion in equity to 200 of their players.
Oh, wow. So instead of just handing out guaranteed cash like LIV does, they gave the players ownership in the league itself.
Exactly, because before SSG came along, the PGA Tour was basically asking players to stay out of a sense of tradition and legacy.
Which is a really hard sell when a rival is offering you hundreds of millions in cold, hard cash.
Exactly. By offering equity, the PGA Tour gave players a direct financial stake in the long-term growth of the sport's dominant platform. It functions as golden handcuffs.
Right, because equity usually vests over time.
Yes. And that shared upside fundamentally changes a player's motivation. You aren't just an independent contractor anymore. You are a partner in the business.
But the PGA Tour didn't just offer a carrot, right? They built a massive stick. The sources outlined this returning member program for defectors.
Oh, yeah, it's brutal.
If a player who left for LIV wants to come back, there are severe penalties. The sources state they have to pay a $5 million fine to charity. They have to play 15 co-sponsored events. And crucially, they forfeit all PGA Tour equity for 5 years.
Right.
The estimate here is that the equity forfeiture alone costs a returning star anywhere from $50 to $85 million.
And that mechanism is deeply punitive by design. The PGA Tour recognizes that they need the absolute best players competing against each other to maximize their own broadcast television ratings.
Of course.
But they can't just welcome defectors back with open arms, or it incentivizes future defections. By making the return incredibly costly, they are systematically destroying the perceived value of the LIV contracts.
Yeah, but you have to factor in the penalty.
Exactly. They are sending a very chilling message. Leaving the ecosystem will permanently damage your long-term earning potential.
It's like a strict parent letting a runaway teenager move back home, but charging them double rent just to teach them a lesson. They are weaponizing their new private equity backing to ensure LIV cannot retain its core asset, which is the talent.
Absolutely.
But the players must also be feeling the pressure because LIV just hasn't achieved the cultural relevance they promised. Let's go back to that OWGR compromise. They finally got world ranking points in 2026, but the sources highlight some massive caveats.
Yeah, the caveats basically confirm the establishment's view of the league. So only the top 10 finishers in a LIV event actually receive world ranking points now.
Only the top 10.
Yes. Furthermore, the mathematical rating of a LIV field is currently equivalent to an opposite field minor PGA Tour event.
Just to clarify for you listening, an opposite field event is essentially a B-tier tournament. It's played on the exact same weekend as a major championship, and it usually features lower-ranked players who didn't qualify for the big event. So the global ranking system is basically saying a LIV tournament is mathematically equal to the minor leagues.
That is exactly how the algorithm treats it, and it's a really harsh reality check for players who view themselves as the best in the world.
I can imagine.
And we saw this play out at the 2026 Masters. While Tyrrell Hatton played well and finished tied for third, LIV's heavy hitters like Rahm and DeChambeau really struggled. Yeah. Rahm even admitted his preparation and his quote-unquote feel weren't right for Augusta's greens. And then you had Sergio Garcia receiving a formal code of conduct warning for a highly publicized tantrum where he actually broke his driver in frustration.
Man, all of that just reinforces the perception that LIV is just an exhibition tour. But the biggest structural failure, according to the sources, seems to be their broadcast strategy.
Oh, absolutely.
I mean, LIV spent a year on the CW network, which is traditionally known for, like, teen dramas and reruns, not live premium sports.
Right.
Then they signed a multi-year deal with Fox Sports in 2025. But golf analyst Eamon Lynch points out a fatal flaw. He said LIV has literally given away their media rights for as long as they've existed.
Right.
Help me understand this strategy. If you give your product away on YouTube for years just to build an audience, how do you suddenly transition to demanding billions in rights fees?
The simple answer is that you can't. And Lynch's analysis hits the absolute core of modern sport economics. A professional sports league is fundamentally a media rights business.
Right.
The ticket sales, the merchandise, the localized sponsorships, those are all secondary revenue streams. If you cannot convince a massive broadcast network or a streaming giant to pay billions for the exclusive right to air your product, your financial model collapses.
Because they trained the audience that the golf was free.
Exactly.
So it's like a local garage band playing free gigs for years, hoping to get famous, only to realize nobody wants to pay for the tickets once they finally start charging. The product itself was built in a vacuum. It feels like they built a product strictly to please their sovereign backers with all the loud music and shotgun starts, entirely disconnected from what actual golf fans wanted to consume.
That is the crux of the issue. The top-down directives to appear innovative ended up alienating the traditional, older golf demographic. And simultaneously, they failed to successfully capture the younger, tech-savvy demographic they were aiming for.
So we have arrived at the perfect storm. We have abysmal financials, fleeing players, and zero media leverage. And all of this has violently collided with global geopolitical realities right now in April 2026.
Yes. The crisis unfolding this week is not just about golf. It is entirely about macroeconomic shifts in the Middle East.
Let's get into that.
On April 15th, the Saudi Public Investment Fund released its new 5-year strategy for 2026 through 2030. In their previous 5-year plan, leisure and sports was highlighted as a core sector for investment. But in this new document, it is completely omitted.
It's completely gone.
Gone.
The sources show they are pivoting to domestic infrastructure and a new AI subsidiary called Humane, which they are betting $23 billion on.
Yeah.
What is the mechanism behind this sudden shift? Why drop sports entirely?
The catalyst is purely geopolitical. The ongoing regional war in the Middle East involving Iran has severely impacted the area. Specifically, the disruption of the Red Sea shipping lanes has taken a massive toll on Saudi export revenues.
Wow.
The reports indicate this conflict has cost Saudi Arabia over $10 billion in lost revenue and emergency expenses.
$10 billion.
Yeah. And when a nation's budget gets squeezed by regional conflict, they are forced into rapid economic consolidation. If the ultimate goal of the PIF is to diversify the Saudi economy for the future, AI and infrastructure are foundational. International sports disruption was just a shiny vanity project.
And when budgets tighten, the vanity projects are the first to get cut.
Exactly.
Which directly causes the operational chaos we are seeing on the ground right now. I mean, the Telegraph and Financial Times are reporting an emergency summit of LIV executives was called in New York.
Right.
And the veteran sports reporter Trey Wingo dropped a bombshell reporting that the Crown Prince, MBS, has literally pulled the plug.
Yeah, that quote made huge waves.
And meanwhile, down at the LIV event in Mexico City, it is total dysfunction. Press conferences were canceled. The media center had power outages, allegedly over unpaid utility bills, and players were reportedly threatening a boycott, claiming they haven't been paid their first quarter wages.
These are classic, undeniable indicators of operational collapse. When a sovereign wealth fund shifts its macroeconomic priorities, the financial tap doesn't just slowly close, it shuts off completely.
Right.
The frozen capital immediately results in logistical failures on the ground, like unpaid bills and delayed player compensation.
But then you have LIV CEO Scott O'Neill trying to manage the narrative. The sources include an urgent email he sent to staff and players claiming the tour is uninterrupted and at full throttle.
Right. Full throttle.
He calls the reports rumors and says they are fully funded through the rest of the year. And he previously claimed they were funded through 2032. I'm looking at O'Neill's email claiming they are fully funded, but I'm also looking at the public Saudi strategy document that literally erased sports. How does a CEO justify writing that email when the public data so clearly contradicts him?
Well, it's a matter of sheer corporate survival. Crisis management requires projecting absolute confidence, especially when your product relies entirely on the retention of highly nervous, highly paid independent contractors.
Yeah, that makes sense.
O'Neill is trying to prevent a mass walkout before the first tee shot in Mexico. It's corporate spin to maintain order, while the executives trying to figure out their next move behind closed doors.
It's like the captain of the Titanic telling the passengers that the iceberg was just a scheduled ice delivery for their cocktails.
Exactly.
You can say whatever you want, but the money has spoken. So let's pull all of this together. We have analyzed the desperate format changes, the financial black hole, the player exodus, and the geopolitical mechanism forcing this crisis. Based on all the verified data across these sources, what is the final strategic assessment for LIV Golf?
The sustainability of LIV Golf is officially rated as fragile.
Fragile.
Yes. Despite the CEO's assurances to his players, the independent league is economically untenable. Without a massive multi-billion-dollar media rights deal and operating amidst a regional war that demands severe fiscal consolidation from its sole backer, the current model just cannot survive.
So what happens next?
Based on the data, we are likely looking at a managed collapse or a quiet, face-saving surrender merger with the PGA Tour by the end of 2026.
Wow. And for you listening, we've distilled all of this complex research down to the three most important trends you need to remember. Number one, geopolitical realignment. Sovereign wealth is incredibly agile.
Is.
The billions that previously flowed into international sports disruption are now rapidly pivoting back to domestic priorities, specifically artificial intelligence and infrastructure, driven by regional economic pressures.
And number two, the corporatization of the PGA Tour. This was the strategic masterstroke. By bringing in American private equity through the Strategic Sports Group, the PGA Tour successfully institutionalized player loyalty through equity grants.
The golden handcuffs.
Exactly. They neutralized LIV's upfront cash advantage by offering players shared ownership in the sport's future.
And number three, the valuation reality check.
Yeah.
You cannot build a billion-dollar sports franchise strictly on star power and a disrupted format. True franchise valuation requires a foundational, highly lucrative media rights business,
Which LIV completely failed to build.
rendering their team franchises commercially worthless to outside investors.
It really is a profound lesson in sports economics. Limitless capital can buy temporary disruption, but it cannot organically buy tradition, competitive relevance, or a loyal viewing audience.
Which leaves us with one final thought for you to ponder. We started by talking about a skyscraper built with unlimited funds that suddenly realized it had no cash register.
Right.
If a $6 billion sovereign wealth-backed war chest couldn't permanently fracture a relatively niche sport like golf, what does this massive public failure mean for the future of private equity or sovereign wealth trying to buy their way into global juggernauts like European soccer or American football?
That is the billion-dollar question.
Will we ever see a disruption attempt on this scale again? Or has the Gulf War served as a permanent warning to investors everywhere? Keep that in mind the next time you see a brand new league making billion-dollar promises.